They come to me asking for a shortcut, a guaranteed system, a magic indicator. I tell them there is no such thing. The market does not yield its fortunes to the lazy. If you desire to fail quickly, though, I can show you the precise path to financial ruin. This lesson is simple. To make money in speculation, you must first understand the fool who loses it. You must understand the destructive mind that approaches this craft as a casual distraction. The fool's prime directive is this: approach trading as a get-rich-quick scheme requiring zero preparation. The fool believes he is entitled to fortune without earning the right to risk capital. He sees his broker account as a lottery ticket, not a sacred trust. He operates on the law of ignorance, which means rejecting all education, statistics, and historical precedents as irrelevant noise. He assumes that because the chart moved yesterday, his trade today requires no study of the past. The market is a place where capital shifts from the undisciplined to the patient. The golden rule of the true gambler is to view his trading account solely as chips on a casino table. He believes the money is already gone the moment he wires it into the platform. This detachment from the value of his capital ensures he will never respect the discipline required to keep it. This detachment is the first psychological hurdle on the road to the poorhouse. If you truly wish to fail, you must operate under the law of all-in. You must bet the majority of your capital on the very first trade you take. Do not waste time with small, manageable risks. Immediate maximum exposure is the key to swift obliteration and is the surest sign of a novice mind. This mentality leads directly to the fool's law of leverage. The fool must maximize margin and leverage at every possible opportunity to multiply his potential losses. He does not understand that leverage is a double-edged sword, designed to accelerate the inevitable demise of the unprepared. He sees only the fantasy of amplified profit, not the reality of amplified pain. Here is the first commandment of ruin. Never define an entry or exit plan before execution. All decisions must be spontaneous. The man destined to lose capital avoids the tedious work of a trading journal and risk calculations. He prefers the adrenaline of the moment. He likes the thrill of clicking a button simply because the price action feels fast. He acts on impulse, not on calculated signal. I have watched countless men of ability bankrupt themselves because they treated the market like a spontaneous adventure. They never wrote down the reason they bought a position. They could never define the reason they should sell it. They traded on hope and fear, which are the most expensive commodities available. The market does not reward improvisation. It rewards documented preparation and machine-like execution. If you do not know precisely where you intend to take profit, the market will inevitably take it from you. If you cannot define your maximum tolerable loss, the market will gladly define it for you. Your job as a speculator is not to react to the chart, but to execute the plan that was formulated when your mind was calm and clear. The second rule to ensure failure is simple. Trade solely based on fleeting emotional impulses, market rumors, and the fear of missing out, or FOMO. The successful speculator does not care what his neighbor is doing or what the chatter is saying. He trusts his own eyes and his own price analysis. The fool, however, is consumed by the idea that someone else knows better. He hears a story about a stock running and rushes in with his entire bankroll, asking questions later. His entries are driven by greed and a panicked sense of urgency. I once watched a man who had made a small fortune over 3 years simply disappear. He liquidated all his carefully held positions in a trend he understood to chase a volatile, obscure asset that was being heavily promoted on the street. He acted on pure envy and the terror of missing a quick ride to riches. Within 2 weeks, the asset collapsed, taking 90% of his capital with it. The market is not a place for social events. Trading based on emotion guarantees your seat among the crowd, and the crowd always loses. To guarantee ruin, you must follow the third and most destructive rule. Always add aggressively to a losing position, doubling down until the account margin call hits. The worst mistake a speculator can make is to hold an admitted mistake and feed it. The fool views a falling price as a temporary discount and an opportunity to reduce his average entry price. He sees a loss as a personal insult that must be fought, not a signal that his initial analysis was wrong. He never asks, "If I were flat right now, would I buy this asset at this price?" The simple answer would save him. I learned early that when I was wrong, and nothing changes that fact faster than buying more. My greatest losses came not from the initial trade, but from my subsequent attempt to rescue it. When you buy more of a loser, you are compounding an error with an act of desperate ego. You are transforming a manageable small risk into a catastrophic threat to your entire future. A loss is a cost of doing business. Double down on a loss, and you have committed financial suicide. Your fourth law of failure is to ignore all macroeconomic context, central bank policies, and the fundamental health of the asset. The fool trades in a vacuum. He believes that the tiny fluctuations on his 5-minute chart exist independently of the global economy. He ignores that interest rates are the gravity of all asset prices, and that the overall tide dictates the health of every ship. He is blinded by the immediate noise of the quote screen. He buys a security purely because the chart pattern looks compelling, even though the company is hemorrhaging cash and the industry is collapsing. He speculates without ever reading a financial statement or understanding the product. I realized decades ago that every major sustained price movement, the kind that makes real fortunes, is rooted in fundamental change. The technical chart merely reflects the recognition of that change by smart money. Trading without understanding the financial weather is like sailing without knowing the season. You are doomed to be caught in a storm you never saw approaching. The fifth step to financial destruction is to trade constantly and continuously, believing that inactivity is a missed opportunity, regardless of market clarity. The fool is addicted to action. He must always have a position on. He fears the boredom of waiting more than he fears the certainty of losing capital. He does not understand that the vast majority of time the market is range-bound and consolidating, offering no clear direction. The professional waits for the overwhelming signal, the clear breakout from the range, the powerful move accompanied by confirming volume. He knows that patience is a form of discipline and that the biggest winners come from sitting still and waiting for the fat pitch. I learned to make money by not trading when the conditions were vague. My capital was safe in the account. Waiting, the fool cannot wait. He must try to scalp pennies in the noise, racking up commissions and exposing himself to countless small losses that aggregate into one massive drain. True mastery of speculation means mastery of the self, and that means being content to watch the market without participating. Rule number 6 is the one that guarantees a total wipeout. Never use a stop-loss order. True believers know the price must return to break even eventually. The refusal to use a stop-loss is not an act of courage. It is a confession of ego. The fool thinks he can negotiate with the market. He substitutes his hope for a predetermined plan. He looks at a stock that is down 10% and tells himself, it's only a paper loss. But paper losses become real losses the moment you need the capital for something else, or when the margin account is closed by your broker. I learned that my stop-loss order was the only true friend I had in the market. It was the only barrier between my emotional mind and total financial devastation. When you enter a trade, you must know your risk, and that risk must be clearly demarcated by a stop-loss. If you are not willing to predefine your point of surrender, you are not speculating, you are praying. The market is not interested in your prayers. It will simply take your entire stake when you allow it to. The 7th rule is designed for instant failure. Chase the hottest stock tips and social media pump and dumps instantly, buying the absolute peak. The fool is always late to the party. He sees a sensational move on the news and believes the move has just started. He fails to realize that the smart money was buying quietly weeks ago, and that the loud social media chatter is their advertising designed to lure the next wave of victims. The sudden, huge volume spikes accompanied by hyperbolic cheerleading are the classic signs of the distribution phase. The professionals are selling their positions into the enthusiasm of the fool. I found that the moment a specific stock became the focus of intense, widespread public conversation, it was already too expensive for me to touch. I wanted to be in before the general public knew the story. If you are reading the sensational headlines, you are the exit liquidity. Chasing the peak guarantees that you will be left holding a worthless asset when the inevitable reversal comes. The successful speculator avoids crowds and focuses on quiet observation. To lose money on winning trades, follow Rule 8. If a trade shows a profit, hold indefinitely, moving the take-profit target higher every hour until the position reverses. The fool understands the need to hold a winner, but he turns holding into paralysis. He confuses patience with a stubborn refusal to capture the gain. He watches his paper profit swell, and his greed prevents him from executing his exit plan. He believes the move must continue indefinitely. He fails to recognize that markets correct and pull back. I once held a fantastic position that had moved over 40 points in my favor. I was up nearly 100% on my commitment. I became arrogant, believing the market would only rise higher to please me. I did not sell a single share. 2 weeks later, a sector-wide correction came, and I watched the entire profit evaporate back to my entry price. I got out at break-even. I had been right and still walked away with nothing. The lesson was brutal. You must define your targets and take your money. Paper profits are only real when they are cash in your account. Your 9th rule for guaranteed failure is to switch your trading strategy, indicators, and time frames daily, searching for the magical 100% win rate system. The fool is a system jumper. He is constantly distracted by the next shiny object, the new guru promising effortless wealth. He never gives any single sound approach enough time to prove itself in different market conditions. He uses one set of rules on Monday, a completely different set on Tuesday, and by Wednesday he is trying to integrate 3 new conflicting indicators. His charts are a mess of flashing contradictory signals. I learned that every reliable method of speculation has periods where it does not perform well. The successful trader stays with his system through the dry spell, understanding that the market cycle will return to favor his approach. The fool lacks the conviction and discipline to trust his own work. He is always one click away from the next system, which he believes will be perfect. The truth is simple. A mediocre system followed perfectly will outperform a brilliant system followed inconsistently every single time. Consistency is capital. Rule 10 is the heart of the failure mindset. Treat all capital as expendable seed money for the market gods, not as a carefully managed business resource. The fool does not respect money. He sees it as merely a tool for getting into a trade, not the lifeblood of his operation. He is willing to risk an amount on a single venture that would cripple his savings if lost. The professional speculator views his capital as a business owner, views his inventory and cash reserves. Every dollar is tracked, protected, and risked only with the full expectation of its return with profit. He understands that his primary job is the preservation of capital. I learned that if I focused on protecting my money, the profits would eventually take care of themselves. The fool's lack of respect for his capital allows him to take foolish risks that lead to large permanent losses. Never forget this. Your trading account is your business. It is not an ATM for the market. The 11th step to certain ruin is to engage immediately and aggressively in revenge trading following any significant loss to win back the money taken. The emotional mind cannot handle a loss. It demands instant psychological retribution. The fool is hurt by the market and wants to hurt it back. He doubles his position size or shifts to a highly volatile asset, hoping for a quick, massive win to erase the pain of the previous defeat. This is not speculation. It is pure, unadulterated emotional breakdown. I remember a day where I was taken out of a position for a legitimate, planned loss. It stung, but it was according to the rules. I immediately jumped back into the same stock with twice the size, violating every one of my risk rules simply because I felt the loss was unfair. Within an hour, I lost 3 times the amount of the original trade. The market is entirely impersonal. It does not know who you are, and it does not care about your feelings. Revenge trading is the surest sign that you have lost control of yourself. And when you lose control of yourself, the market takes control of your money. Rule 12. Believe that technical analysis is the only truth and ignore any contrary news or earnings reports. The fool treats the chart as a sacred text that exists in a perfect vacuum. He sees a beautiful technical pattern, a textbook breakout, and takes a massive position, completely ignoring that the company is reporting catastrophic earnings in the morning. He ignores the power of fundamental reality. Technical analysis shows the market's footprint, the path of smart money. But the fundamentals are the reason for that path. I learned that the most powerful moves happen when the technical picture and the fundamental narrative align. When they clash, the fundamentals almost always win in the end. The professional speculator uses the chart for timing his entry into a fundamentally sound trend. The fool uses the chart as a shield against reality. The market will always punish the man who ignores the truth of valuation. To destroy your mental health and your trading account, follow Rule 13. Obsessively monitor charts minute by minute, abandoning sleep and real life to micromanage volatile entries. The fool thinks that being glued to the screen somehow gives him control over the price action. He cannot leave his desk. He trades on the 1-minute chart, reacting to every flicker of volatility, constantly adjusting his orders. This constant monitoring is not diligence. It is anxiety given form. It leads to overtrading and the destruction of clear thought. I have always preferred to look at the daily and weekly charts to understand the major trends. The noise of the minute-by-minute trading is designed to confuse and exhaust you. Once I placed a trade based on my documented daily analysis, I was disciplined enough to walk away. The price action I missed between the hours of 5 and 9 was irrelevant to the major move. The fool exhausts himself by fighting the intraday volatility. The professional lets the major trend do the heavy lifting. Time away from the screen is time for clear, rational thought. Rule 14 for failure. Seek confirmation bias exclusively, deleting or disregarding any market analysis that contradicts your current position. The fool is a terrible listener. Once he is invested, his mind closes. He views any negative news about his position as a personal attack or a conspiracy. He will only read articles and listen to commentators who validate his choices. The market will always offer information that contradicts your position. The professional views this contrary information as a necessary test of his thesis. He seeks it out, trying to find the flaw in his logic before the market does. I learned that my job was to be my own harshest critic. If the facts changed, I was ready to exit without prejudice. The fool cannot admit he is wrong. His ego is tied to the price of the stock. Confirmation bias is a psychological trap that blinds you to clear signals of a trend reversal. When you cannot admit you are wrong, you cannot take the necessary action to survive. The final essential rule for the failure artist: overcomplicate analysis by using 30 conflicting indicators simultaneously, generating paralysis by analysis. The fool believes that complexity equals expertise. He has RSI, MACD, Bollinger Bands, volume profile, stochastic oscillators, and a dozen other lines covering his entire screen. He waits for all of them to give the exact same perfect signal before he acts. The signals will never align perfectly, and the result is indecision. He sits and waits while the clear, obvious trend moves without him. I learned that the chart only needs 3 things: the price, the volume, and the dominant trend line. Everything else is noise designed to confuse and exhaust you. The market moves on human action and reaction, not on the crossing of lines. The essence of market analysis is simplicity. The more complex you make your analysis, the slower you become, and the faster the market will leave you behind. I have shown you the path to ruin. Now understand the truth of what I have delivered. The law of inverse wisdom states that true success is built by systematically rejecting every single rule designed for failure. The profitable speculator is simply the man who refuses to make the mistakes that bankrupt the crowd. Your fortune is not made by genius. It is made by the relentless avoidance of folly. The professional knows that the majority of people lose money and he refuses to join their ranks. He does not seek the quick, easy dollar. He seeks the disciplined, low-risk opportunity. This requires the complete adoption of the law of risk management. You must guard your capital fiercely, defining your maximum tolerable risk before entering any position. Never risk more than a small, defined percentage of your total capital on a single trade. If you do not know precisely how much you stand to lose, you have no business putting a trade on. I never worried about the profit of a trade. I worried only about the risk. If the risk was contained and the opportunity was clear, the profit would naturally follow. Protecting your capital is your first job. You must then adopt the law of discipline. Execute a tested, documented trading plan consistently, removing emotion from the decision-making process. Your plan is your business, and it is non-negotiable. When the signal comes, you act. When the stop hits, you exit. There is no debate, no second-guessing. A plan that is in writing is a plan that can be tested, refined, and trusted. A mind full of indecision is a mind destined for poverty. The successful speculator is cold, calculating, and machine-like in his execution. Finally, you must live by the law of humility. Accept inevitable losses quickly, treat them as tuition, and never allow them to trigger psychological revenge cycles. Being wrong is simply a cost of doing business. The market has no opinion of you. When a trade moves against you, you have a signal. Get out. Do not argue with the signal. The hardest check to write is the one that admits you were wrong, but it is the cheapest lesson you will ever pay for. Never let a manageable cut become a mortal wound. Your profitability is determined not by the movements of the market, but by the relentless quality and execution of your process. The market will always be volatile, unpredictable, and entirely impersonal. It is you who must be consistent, disciplined, and predictable. Focus on the process, not the outcome. Focus on the rules you have set for yourself, not the rules others follow. The difference between the fool and the professional is that one operates by impulse and the other operates by law. The choice is yours. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I'm talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.